So I must say, I'm not super happy today while I'm doing this video because I had to spend hours and hours reading financial statements, reading a short report about Brookfield Infrastructure, and trying to make sense out of it. Dividend growth investors, bonjour. My name is Mike Hu and I'm the founder of Dividend Stocks Rock, and I'm also a passionate investor. And when you're a passionate investor, well, when there's a question that needs your attention, you go and you do a deep dive, right? So today we're going to talk about first Brookfield Infrastructure's earnings, which were well received by the market, and on the earnings day, the stock price jumped by 10%. And then we're going to look at the short report to see what really happened there and why the stock plummeted before, and it's still not a good performing stock over the past 2 years. I must admit that, so that's not a problem here. But seriously, trying to make sense of what the short seller is saying, and he does have like some valid points, but at the same time, there are some other interesting part that we need to consider before we make a decision that we want to invest or we just want to drop this one down the drain. So let's start with the Brookfield Infrastructure business model before. After that, we're going to move towards the earnings results. And after that, we're going to end this video with the short report. So Brookfield Infrastructure, what is it? Well, first, it trades on the stock market under BIP, bip.un.to, BIPC, and BIPC.to. So partners are regular class share on both Canadian and US side. If you want to know which one is best for you, I did a report in February about the entire Brookfield family. You can download this in the link description below. The report, even though it was made in February, the business hasn't changed. In fact, the beauty about the Brookfield family is that they invest in patient assets. So they have like capital that is being invested in super long-term asset. So you need to be patient. That's the key, right? So when you invest in toll roads, in bridges, in data center, in pipeline, it doesn't always make money right away. It takes a long time, and this is where Brookfield comes in because they're not stressed. They have a huge track record for several years, and they can show how they can manage those assets in a profitable way and increase their distribution all the time. So for today, we're looking at Brookfield Infrastructure. So Brookfield Infrastructure is separated in 4 businesses. So you have midstreams, utilities, transportation, and data center. And as you can see, on top of having a multiple different types of industries under their belt, they also do business across the world. So to make it simple, utilities takes over 33% of the revenue, transportation's at 31%, midstream at 26%, and then data center at 10%. So you could say 30, 30, 30, and then 10% for data center. That gives you a pretty good idea of how the business is run. Now going on with the good news of the earnings and why the stock price went up. Well, actually, it was up 10%, but not necessarily because it was like incredible results, but most likely because the stock price has been so hurt over the past 2 years that at one point, if you have good news, if you have good numbers, it's just normal that there is a realignment, and then some investors think, oh, it's not the end of the world. So when you look at the FFO this quarter and funds from operation, this is at the center of the short report. We're going to talk later today in terms of their calculation, but if we allow Brookfield, if we trust Brookfield with their calculation, it shows a FFO of 560 million, up 7%, mostly because they were able to increase their rate and their charges for across their business, mostly because they have index inflation contract, and also because they make acquisition every single year. So its business model, what we're going to see later on today, is they buy assets, they tweak it, make it better, get some distribution out of it, and when it's the right time, they just sell them, cash a profit on the added value they created on this about this business, and then reinvest that money into another one. So this is called capital recycling, and they have been doing that for a long time. So rapidly, for the utility business, FFO of 229 million, up 17%, mostly coming from organic growth. So 10% organic growth, just like inflation. index in their contract, so that goes up like almost naturally every single year. And then the other 7% growth is coming from some acquisition. So overall, a pretty solid quarter for the utility business. Now for transportation, similar story here, strong organic growth of 7%, partially offset by higher cost of financing. And obviously when you can think about any utility business, they're capital intensive. This means that they need to invest a lot of million, and actually we're talking about billions for Brookfield. So obviously debt is coming up, and then interest rates are increasing every quarter as they renew some of their old debt. It's going to continue because they have a well-diversified maturity for their debt, but still every quarter it costs a little bit more to do business for them, and it's going to continue throughout 24, that is for sure. Moving on to the midstream, that's the only segment where we see a decline in the FFO. So 163 million, down by 5%, but mostly because they have sold some of their interest in a US gas pipeline. So again, as you can see, whenever they have a chance to sell at a good profit, they sell part of their assets and then they reinvest something somewhere else. But when you sell an asset, it will obviously affect your ability to generate funds from operations. And the last but not the least, obviously smallest portion of the Brookfield Brookfield Infrastructure, data center is up 10%, mostly on acquisitions. So once again, asset recycling at its best. The company continues to buy interesting assets, especially in this world where there's a negative sentiment around the economy. Interest rates are putting pressure on a lot of businesses, and then companies with a lot of liquidity and ability to generate more funds by getting more debt, they will, like Brookfield Infrastructure, they will come in and buy those assets at a cheap price, and eventually they'll be able to sell it at a higher price. Brookfield, like most Brookfield Corporation, did that trick in 2008 during the financial crisis, and it seems that they're going to do it again right now as some assets are getting depreciated. So overall, it was a solid quarter, a lot of growth, a lot of organic growth. The company is in good shape, well, per management, because when we think about the short report, this is not exactly what they see. So the short report was issued a few days before BIP declared their earnings. So one reason why it went up that fast is because it was just cratering a few days before based on that short report. So the short report basically blamed Brookfield for two major points in this thesis, and it's like 79 pages if you want to go through it. It's heavy. There's a lot of accounting principles in there, a lot of like financial charts, and one thing the author is doing is he is telling us the way FFO is being calculated by Brookfield is not accurate. And that is probably one of the biggest problems with funds from operation, FFO and AFFO calculation. They are not GAAP measures, so generally accepted accounting principles. So it basically, long story short, management can pretty much calculate it the way they want and make you believe what they want, because yes, they will provide you with some calculation information, but in the end, it's not standardized. You cannot compare Brookfield FFO per unit with another utility business that will still use FFO. So while it's relatively commonly used for utilities, it's really hard to see through that. Just to add another layer of problems around Brookfield Infrastructure is they do not declare financial earnings and statements for each of their investments because they have plenty. So even in the report, there was a lot of assumptions, and also they mentioned the fact that there was 54% of assets that they could not even look at in terms of financial reports. So in my opinion, it makes the short report a little bit less relevant because the author brings a few good points in saying that the accounting is quite opaque. It's really hard to understand all the numbers, and there's a good part of those numbers that you must trust management with it. Is it a good thing? Definitely not. We like to have things that are quite simple, but I mean, not all companies reports consumer goods like Pepsi-Cola or Coca-Cola, where they just saying, oh yeah, well, here's the cost of doing business, here's the sales, and here's the profit, and you can pretty much picture how this business is running. So for Brookfield Infrastructure, there's a lot of assets that is being purchased, and some others are being sold, and then they're getting, some of them they own completely, some others it's only like a portion of it, so like a 25% stake in a utility business, for example. So it makes it even harder to understand, and I totally agree with that part of the report. The problem is more like it was a little bit harder to make the real proof that all their assets are not generating the FFO that Brookfield Infrastructure is saying they are. The second part of the report, which was not that appealing to me because I don't give much value to valuation method, but what he's saying is the net asset value is way too big to what it is right now. So basically the stock price should plummet by another 70%, which is a lot, to be honest, because I don't think that all their assets are worth zero or near zero, because like another claim that we found in that report is like a lot of businesses that is owned or operated by Brookfield Infrastructure are distressed, are struggling, and have a lot of problems. And instead of like going like line by line and explaining you everything that they are doing in the 79 pages, I decided to look at the business model at Brookfield and see another side of the story. So assuming that the short report is right, maybe you can tell me why credit agencies are giving a BBB plus rating from two credit agencies, and they're saying that Brookfield Infrastructure balance sheet is solid. So if all of their assets are not what they're supposed to be worth, and all of their businesses are not generating cash flow but rather in distress and in need of money, it's kind of like surprising that credit agencies would still give a good rating to that business, right? As I mentioned earlier, they have a debt portfolio that is well diversified in terms of maturities, and 90% of it is long-term fixed rate debt. So again, it will create some stability for that. But the point was more like, well, if credit agencies believe in the business and the structure, I'm not too sure how it's making sense with the short report. Another problem from the short report that was highlighting is if the business is not able to sell assets, they will not be able to fund their capex and to continue to grow. And then I started to think, well, if all businesses or most businesses or several businesses are in distress and having problems, and they're not generating that much cash flow, how is it possible that you can actually sell asset at a profit? Like nobody looks at that when they're trying to buy something from Brookfield. And then I went to see what were their latest asset sales, and as you can see in their latest Brookfield investors presentation, they discuss the US natural gas pipeline that they the part that they sold recently, some data center in New Zealand, and then gas storage in the US. And you can see we have internal rate of return of 18% and 31% for the first two assets that have been being sold. So the concept of asset recycling seems to be pretty solid at this point, and it's pretty much like the same thing every quarter, every year, where they tell you that they sold, for example, they sold stake of a railroad in India, they made profit out of it. So if they're able to make profit when they're selling assets, I'm kind of questioning how come all of those assets should be devalued and then that they're technically in distress. And to end that report, one thing that, I don't know, I found it also very strange in my opinion, is you can't fake FFO, that's true, but can you really fake it for more than 10 years in a row? As you can see on this graph, we see 10 years of double-digit FFO per unit growth, and the distribution was increasing accordingly. So the target rate has always been between 5 to 9% per year of a distribution increase. So when you're seeing this, you're thinking, well, it's been a decade where Brookfield is fabricating numbers with dying assets, dying businesses that are actually cash flow demanding instead of cash flow producing. And going forward, management continues to tell us it's going to continue. So how could they increase a distribution, because you cannot fake that. That's real money getting out of the business, and still 10 years later as a solid investment grade from credit agencies, and continue to do that kind of business, selling assets at profit. So I'm not saying that the entire report is wrong. Definitely the author raised good points. The most important one, and I think it's really important, and I'm going to end on that note, is if you find that Brookfield is confusing, you are 100% right. If you find that their structure is really complex, again, same things, very true. But then if you're not comfortable with that, you should just move on and not invest in that type of business. This is the type of risk that is there. You decide if you want to be part of it or not. I prefer to focus on the fact that management has a very long track record, and it's not like a company that has recently starting to show signs of struggle. They've been doing great for more than 10 years. Is the higher interest rate environment will shed some light on this, and then we're going to realize that management was a fraud? We'll see. I don't think it's going to happen. This is not the way I see things with the numbers and the business they're doing, and the fact that they're able to generate profit by selling assets in a negative environment right now. But again, those are real risks, and if you are concerned about those, probably that Brookfield Infrastructure is not a good investment for you guys. So I hope that you have enjoyed the video. Let me know if you have any other questions about Brookfield or any comments in the comment section below. You can also download my Brookfield report. It was created and it was done in February, which is actually a report that I'm updating every single year for my members at Dividend Stocks Rock, so they're the first one to receive it. But then I don't mind sharing it with you. Most of the information is still relevant today, because you know what? Brookfield Infrastructure was still investing in utilities, midstream, and data center 6 months ago. All right, guys, see you next Thursday, and don't forget, in the meantime, to stay invested.